Welcome to the Economic Rockstar Podcast with your host, Frank Conway, connecting brilliant minds in economics and finance.
In this week's episode of the Economic Rockstar Podcast, I speak with Eugene Fama, Professor of Finance at the University of Chicago Booth School of Business. We talk about the study of economics in the 1960s compared to now. There's a dissertation on the efficient market hypothesis and how it relates to the random walk and submartingale process, the beginning of mathematics and economics, stock market anomalies, why everybody wants to publish papers and how this is a problem in academics. We also discuss some of Professor Fama's recent papers on federal funds rate and whether there was ever a lending channel. We hear about his opinion on Bitcoin, about his own hobbies and how he uses them to regain balance in his life as an economist, and some of his daily routines. You can check out the show notes to this episode on economicrockstar.com/Eugene Fama. I would like to give a big shout out to this week's supporter of the Economic Rockstar podcast, Eugene F, professor and researcher at the Pennsylvania State University. Eugene actually featured in episode 4 of the Economic Rockstar podcast and is officially the first economist to feature here. Check out jadrianwooten.com. Thank you so much for your generous support on my Patreon page. Economic Rockstar is a free podcast that does not exclude anyone from listening as long as they have a device to listen, download or stream. I have many listeners from all parts of the world, and I truly am pleased to know that the Economic Rockstar podcast unites all of you through the common theme of economics. I strive to commit to releasing an episode each week and aim to develop Economic Rockstar into much more than just a podcast. Patreon is a platform that gives you, the listener of the Economic Rockstar podcast, the opportunity to express your appreciation of the show by committing a financial reward for as little as $1 a month. Patreon allows me, the creator of the Economic Rockstar podcast, to be rewarded and paid by you so I can continue with the running costs of the show and to reinvest and expand the podcast into other platforms or mediums in the future. To find out more on how you can help the Economic Rockstar podcast and have your name added to the supporters list on my website, please check out my Patreon page at patreon.com/Economic Rockstar or visit the supporters page on the Economic Rockstar website. Just to give you a heads up before you listen to my interview with Professor Eugene Fama, at times the audio quality is a little poor. I've done my best to remove some of the interference and to improve the audio quality. So let's get started and enjoy this episode with Nobel laureate Professor Eugene Fama.
I call asset pricing theory and efficient markets the two kind of Siamese twins of asset pricing. You can't have one without the other, and you have to really use both in order to conduct any tests. And that's what makes it more complicated. Well, you have to be careful. I think it has to be systematic empirical work. You can't just go work with anecdotes. Anecdotes are not empirical work.
Professor Fama was awarded the 2013 Nobel Laureate in Economic Sciences and is widely recognized as the father of modern finance. His research is well known in both the academic and investment communities. He is strongly identified with research on markets, particularly the efficient market hypothesis. Professor Fama focuses much of his research on the relation between risk and expected return and its implications for portfolio management. His work has transformed the way finance is viewed and conducted. Professor Fama is a prolific author, having written 2 books and published more than 100 articles in academic journals. He is among the most cited researchers in economics. In addition to the Nobel Prize in Economic Sciences, Professor Fama was the first elected fellow of the American Finance Association in 2001. He is also a fellow of the Econometric Society and the American Academy of Arts and Sciences. He was the first recipient of 3 major prizes in finance: the Deutsche Bank Prize in Financial Economics, the Morgan Stanley American Finance Association Award for Excellence in Finance, and the Onassis Prize in Finance. Professor Fama was awarded Doctor of Law degrees by the University of Rochester and DePaul University, a Doctor Honoris Causa by the Catholic University of Leuven, Belgium, and a Doctor of Science Honoris Causa by Tufts University. Eugene is chairman of the Center for Research in Security Prices at Chicago Booth, which was founded 40 years ago to create the finest tools for tracking, measuring, and analyzing security data. He is also an advisory editor of the Journal of Financial Economics. Professor Fama earned a bachelor's degree from Tufts University in 1960, followed by an MBA and PhD from the University of Chicago Graduate School of Business, now the Booth School, in 1964. He joined the faculty in 1963.
Hi, Frank Conway here, and you're listening to the Economic Rockstar podcast. I'm so honoured to have Nobel laureate Professor Eugene Fama join me today. Hi, Eugene. Welcome to the show.
Hi. Thank you.
Eugene, what I'd love to start off with is going back to the very beginning, maybe the earlier days, and just have an idea of what life was like growing up compared to today in academia, perhaps, or whether your formative years in your household had an influence on how you decided to take the path into economics.
Well, I was the first person in my family to go to college. So I was a third generation Italian, and none of the previous two generations had gone to college. So I was the first one to do that. And when I went to Tufts, I thought I would study Romance languages and eventually be a high school teacher and a sports coach. But I got kind of bored with that, and I took an economics course in my junior year in college and loved it and switched to economics thereafter. And then I went off to Chicago after I graduated from Tufts.
And was the fact that you're Italian made you choose something on the romanticism side before you, or is that just a stereotype?
No, I don't think it had anything to do with it, actually, but it certainly had nothing to do with me eventually choosing economics.
No.
And Italian wasn't one of the languages I was studying anyway.
But Italians are stereotypical romanticists, I think, based on the works of the Renaissance artists and the good looks that they have as well. I'd love to find out how, as an academic then, as a student, what it was like in terms of the approach to economics compared to today. I know in terms of the mathematical sense, it was pretty much in its infancy. And you were at the forefront of that with Paul Samuelson and in that time period.
Well, no, I'm not a mathematical person, so I would have had trouble getting through today's PhD programs. I'm more of a statistical kind of a person. If you look at the theory papers that I've written, they're all very basic, and there's never much math in them. So I never took any math courses, and it's all basically self-taught. So I'm really an intuitive kind of economist, and most of my work is empirical.
And is the rigor that you had undergone in terms of the level of academic rigor, would you have noticed any fundamental changes in the approach taken in your years as a student compared to how you taught or how you teach in Chicago today to these present-day students?
Economics has exploded since then. The courses were very thin in those days. This is the early 60s where we're talking about. The courses were very thin, and the research that was being done it would look really primitive by today's standards. And basically every area has exploded in terms of theory and empirical work in the ensuing 50 plus years. So the world looks much different today than it did then. For example, most of my work is in finance, and really academic finance didn't exist.
No.
When I started, there were no courses worth taking in finance in those days. I took most of my work in economics. The finance courses were really a joke. It took basically the late 60s and 70s were a time when finance exploded, both in terms of theory and related empirical work, to become, in my view, the most successful area of economics. But none of that existed back then.
Yeah.
And that's true in other areas. So if you look at, for example, microeconomics, it was a dead area for a long time until Gary Becker and others came along and got them thinking in different ways. And then that area exploded both in terms of theory and empirical work. To be, really most people are, so many people coming out these days in economics tend to be applied micro people.
And I suppose not since the times the classical economists, perhaps we haven't seen such an explosion in economics as you mentioned there. I suppose the 1950s and 60s onwards has given us a lot of different types of approaches to understanding economics and to apply them to the real world. And you have the likes of Keynes in the 20s and von Hayek and then Milton Friedman.
Right. Well, those people all made important contributions, but they were kind of unique in their era, I think. There isn't that much from early economics that made a big impact, a big lasting impact.
That infamous dissertation that you worked on in the 1960s,
Right.
You were a young economist, a young academic. Did you know what was going to be ahead of you when you were starting out, or how your dissertation evolved on the efficient market hypothesis? Were you aware of how much of a contribution this was going to be to the finance and economics discipline?
Well, I think all of us working in the area at that time thought it was a big deal, but I think researchers always think their stuff is a big deal. So this happened to work out quite well. But, that was a unique period in the sense that computers were just coming around. So people were able to do empirical work that they couldn't do before without having a large number of research assistants who may do it right or who may do it into the data incorrectly. And that kind of freed up empirical people to do work that they weren't able to do before. And that was, in finance, there's lots of available data that could be used in empirical work. So finance was one of the first areas that really took advantage of computers, and I was lucky to be there in the beginning.
When you were doing your work on the efficient market hypothesis, Paul Samuelson came across a paper by Louis Bachelier. Were you aware of that paper at that particular point in time, or was it?
I don't think it was Samuelson. I think it was
Kuttner, was it?
No, Benoit Mandelbrot. He was the one that made me aware of it. He was French, of course, yes. And he was aware of Bachelier's work. Now, I don't know, maybe he got it from Samuelson, but I don't think so. I think he was the one that discovered it, because he would have been able to read it. It was never translated until Paul Kuttner had it translated.
That makes sense, actually, that Mandelbrot would have discovered that paper or brought it to the attention to the academic world.
I think he came across it during his own graduate days in France.
And was that such a pivotal point in how we would look at stock markets back then?
I don't know if you read Bachelier's paper, whether you would have extracted that message from it.
Yeah.
I mean, after the fact, there's always stuff that looks like it had the idea before whoever gets credit for it had it. But then you would look back and say, well, if I hadn't read other people's stuff, would I really have read Bachelier that way? And I don't know if that's true or not. I don't think it is.
And would you think that could be a problem in any discipline when you're doing research, that if there is an interpretation of people's work, that you might fall into that person's interpretation, whether it's a correct or incorrect interpretation? There might be something missing, especially if there's a translation involved.
Yeah, well, I don't think it was an incorrect
interpretation
of Bachelier. I just think it would be kind of hard to pull it out of him what he did. But it was path-breaking stuff, and he never got credit for it.
For those people who haven't or may know a little about your work, who might be listening to this podcast, would you like to explain perhaps what the efficient market hypothesis is and how you related it to stock markets in terms of, say, the random walk or the sub-martingale process?
Yeah, well, it's a very simple hypothesis. It says prices reflect all available information. That's very simple, but testing it turns out to be very difficult, because you have to say what what's going on in the setting of prices. And that really requires a model of risk and expected return. So I call asset pricing theory and efficient markets the two kind of Siamese twins of asset pricing. You can't have one without the other, and you have to really use both in order to conduct any tests. And that's what makes it more complicated. So, for example, when we originally started out, we thought, well, random walks were the thing, but that implies a model of risk and expected return that's very restrictive. So people backed off of that. And then martingales came along and sub-martingales, and all of that's is really having to do with the underlying statements about what's important in pricing. In other words, how you measure risk and what's the relation between expected return and risk.
Some people, understandably, could be skeptical of this, even though it's as you put it there, it's a simple model that explains the market and how asset prices might reflect all information. And you broke these down into three forms.
Right.
When you talk about then the randomness of it, would that be related to price levels or changes?
What's random is the deviation of the return, the difference between the observed return and what was expected before the fact. Basically, what efficient market says is that difference is unpredictable.
You broke it down into three forms: the weak, semi-strong, and strong form.
Yeah, that was just a way to differentiate between the kinds of information that people used in different kinds of tests.
And with the power of computing today and the transfer of information that's almost instantaneous, do you think the weak form efficiency where prices reflect all information, would you think that's more true today than it would have been?
Well, that's a question everybody asks, and I don't think we have seen much, or we're not able to document a big change in the efficiency of the market. It's always looked pretty efficient. And there's so much noise in the data that you can't really tell whether it's improved or not.
Would this noise be associated with, say, speculators in the marketplace?
Well, it can be associated with just new information coming in, people reevaluating old information. It can be associated with lots of things, but it's basically a large amount of randomness in asset prices from one day to the next that reflects movement to a new equilibrium.
And that's just explaining how markets are so dynamic.
Right.
As you referred to earlier on, I suppose no one steady state in the markets whereby there might be independent, identically distributed, which...
No, there's no need for that.
There's no need for that at all.
No. So that's a much more restrictive view of efficient markets. There's nothing about prices reflecting all available information that says anything about what the distribution of unexpected price changes should look like. It's just that it should be unpredictable.
That predictability or unpredictability of markets, I should say, reflects perhaps, if you looked at the hedge fund industry, we can see that hedge fund managers may not be able to, if they were successful one particular time period, they may not be able to repeat that success for another time period.
Yeah, right. Most performance can be attributed to luck, not skill.
This is what the efficient market hypothesis implies, that if you end up beating the market average, that it could be all down to luck.
Right, and there are lots of studies that show that there's no persistence in performance, that people that have won over the last 5 or 10 years, it's unpredictable whether they will win in the future.
At the time when you published your research on the efficient market hypothesis, this brought about another kind of explosion within the finance and economics discipline to test the hypothesis that you put forward, or the hypothesis that was being discussed at that time period. Right. Obviously you'd have your proponents of it. Burton Malky will be one particular example of somebody who supports your work that comes to mind. And recently I've had economists who supported your work as well, like Harvey Campbell. Again, he supports your work behind market efficiency and acknowledging that you also acknowledge markets can be inefficient too.
Well, nothing is perfectly anything, so there has to be some amount of inefficiency in markets. It seems to be very difficult to find it, and it's very difficult to identify it among portfolio managers, for example.
And would that be due to, say, human behavior or the nature of humans in terms of how they're trying to process the information, whether they process it correctly or not? That causes.
Well, I don't know. The basic reason is that prices and returns are so noisy that there's so much randomness in them that it's difficult to identify actual skill.
So from that, you had a surge in research on stock market anomalies.
Mm-hmm.
How and what an anomaly is, like a falsification of the efficient market hypothesis, where people.
Well, it's usually a falsification of the other part of the hypothesis, which is the model for risk and return.
And they imply with the studies that markets can be beaten if you use a particular trading strategy. For example, a momentum strategy.
Yeah, momentum is the biggest example. Very difficult after that to find anything that's actually robust.
Yeah, especially if you look at something like the January effect, or
right.
There's so many different types of effects that they all tend to smooth out over time, and there's almost a randomness in that as well in terms of the returns.
There's starting to be studies that come out that look at the so-called anomalies and say how many of them are observed in data outside of the data used to discover them. And then you find that lots of them really disappear when you look at them in new data. But that's an area that still has to be fleshed out a lot. See, there is a problem in academics that everybody wants to publish papers. That's the way they advance and get tenure and get higher salaries. They also get notice on Wall Street for doing it. So there's an incentive to dredge the data and come up with things that will be attention grabbing, but won't necessarily be there in new data and aren't the basis for investment strategies.
And I find that based on the readings of the studies myself, even though I haven't performed any of the research independently, but looking at it, we see, say, trend lines where there's a disappearance of some of these anomalies and not the momentum effect. Did you find it entertaining, or did you find it difficult at the time, or did you just blank it when academics were putting this research out to try to make a name for themselves given the popularity of the topic at the time, or did you find it as a personal attack?
No, I don't really have any vested interest in it. The first person that I know of that discovered momentum was Cliff Asness. He was one of my PhD students.
Sorry, what was his name?
Asness, right. He's an investment manager at this point. But he came to me and showed it to me, and he thought I would be upset by it. And I said, this is the data, this is what it says, so publish it. But he had already been scooped at that point by Jagadish and Titman, had the same results like 6 months earlier. So Cliff never got credit for it.
Oh, that's unfortunate, yeah.
Yeah. Well, it's all right. He's very rich now, so it doesn't really matter.
Well, that's what counts anyway, actually, doesn't it?
No, not really. But
it doesn't really matter.
But he's very successful. He doesn't need that.
Yeah, but even Jagadish and Titman themselves, they got criticized for perhaps data mining their work in order to fit the model, have the data fit the model.
Well, but right. So robustness is the name of the game. And their results were scrutinized by many people thereafter and applied to different time periods and different markets. And they showed up pretty well. So that's one anomaly that seems to be robust. And it is what it is. I mean, you have to live with it. It contradicts market efficiency, I think. But, that's the name of the game. All scientific theories have anomalies. Otherwise, they're not theories. They're reality.
That's true, actually, yeah. Is that the beauty of economic science?
It's the beauty of all science. All science is you propose models, you test them, and you come up with some stuff that says this works pretty well, and then you come up with other stuff that says, well, it doesn't work very well on this particular so-called anomaly. And so you either tweak the model to incorporate that, or you just accept it as one of the shortcomings of the model. That's why you call them models.
Professor Fama, when you accepted your Nobel for the Prize in 2013, what did you consider your speech to be, or how did you come up with the topic?
Well, you do two talks. You do one long talk to a big room of people who voluntarily come and attend. It's a huge auditorium. And then at the dinner, you do a short talk that describes your work in 5 minutes, basically. And, they're much different. The longer talk is a little more technical, so you describe and you outline in a little more detail what it is you think they gave you the prize for. And then in the short talk, you boil it down quite severely. So in my short talk, what I basically said was, finance is the most successful area of economics in terms of the penetration of theory and empirical work into practice. You don't see that in much of economics. So much of economic theory, for example, tends to be of interest only to other economic theorists. It's really doesn't say much that relates to what goes. It purports to say stuff about what goes on in the world, but nobody takes it really seriously at that level. And that's true of lots of work in economics, especially the really high-level mathematical stuff. But finance is really unique in the sense of, well, take, for example, the options pricing model. Black and Scholes and Merton came up with in 1973. That started a whole industry. I mean, first of all, every PhD student in finance and economics has to be aware of it. And it started an industry of people who use it to price derivatives. So it's hard to imagine another paper in economics that had that much impact.
Yeah, true. And it was
efficient markets has changed the investment management industry dramatically in the last 50 years.
In what way?
Well, it's much slower than the options pricing model, but you see slowly through time that passive investment management has become more popular.
Yeah, it actually has. I've heard interviews and read up on that passive investing and how ETFs, trading in ETFs is possibly a good way to invest in, and maybe that's just the noise that we're receiving rather than trying to stock pick. And is that one way of investing passively?
Sure, but the ETFs are one way, but there's a whole range of passive mutual funds that are absorbing more and more of the mutual fund business.
That was an interesting year, 2013, for the Nobel Prize. There were 3 winners that particular year, Eugene.
Yeah, right.
And how was it with Robert Shiller? Professor Robert Shiller was one there too, and he has done his own great work in the area of finance and economics.
Right.
Would you have met Professor Shiller prior to this?
Oh, sure. I know him for a long time.
He has his own, obviously, independent work, and you might have crossed over in terms of your paths academically. How would that have... What am I trying to say here?
I don't know.
When he did his work on price-earnings ratios with John Campbell, he would have not stated specifically, but in some way, if people were to do that type of work, they usually in their literature review talk about the efficient market hypothesis and use the price-earnings ratio to try and identify ways of looking at a portfolio of stocks that you could use to invest in and beat the market overall based on their earnings. Did you ever have a discussion with Professor Shiller on these matters?
Well, that wasn't his. He didn't work really in that area. His article was about what his proposition is that way back when, in the early 80s, was that stock prices are too variable to be explained by the efficient markets hypothesis. But his model basically assumed that expected returns were constant through time. And if you let them be variable through time, then his arguments really are not verified. But he's a firm believer that markets aren't efficient.
Yeah.
But he doesn't document that with empirical work.
Yeah.
It's just a belief.
And that can be very hard to hold up as a belief if you, as a scientist anyway, who doesn't document it through empirical work. and maybe rely on the empirical work of other people.
Well, that's my...
Or even on observation.
Well, you have to be careful. I think it has to be systematic empirical work. You can't just go work with anecdotes. Anecdotes are not empirical work.
When you say anecdotes are not empirical work, say, for example, the stock market crash,
right?
It might have been assumed that the efficient market hypothesis would have priced all those stock prices to be correct at that particular point in time. And is that what we mean by not looking at an anecdotal evidence?
Well, that flash crash that occurred has never been explained. What people initially thought it was, just they couldn't document it. So things can happen that look anomalous and they can't be explained. Maybe that means that markets are inefficient, but it doesn't necessarily. And it's only one point, you know.
Can I ask you on some of your other recent research, Eugene?
Sure.
You do research on the Fed funds rate and the lending channel.
Right.
And some of your recent papers, one of them, does the Fed control interest rates? And we're looking at how the Fed might have that particular effect on economic activity in either the short term or the long run.
Right. Prior
to the quantitative easing, the Fed would have been able to manage the reserve requirement by charging banks. And I think it was after the 2008 crash that they began to adjust the policy regarding how they treat interbank loan rates.
What they did was they wanted to expand their balance sheet dramatically by issuing tons of reserves. So basically, I think at this point, it's well over $3 trillion worth of reserves that the U.S. Fed has issued and used it to buy long-term securities. That, in principle, should have pushed short rates up, but short rates went to zero at the same time. So that wasn't due to the actions of the Fed. The actions of the Fed should have had the opposite effect. And if they thought they were pushing down long rates, but people that have studied that have said that the effect was basically non-existent.
So the expectation of the Fed was to push up base rates at that time, was it? And they actually went the opposite direction?
Well, no. So what they had to do was they had to start paying interest on reserves, which they had never done before. So to get the banks to hold these reserves that they were issuing to buy longer-term securities, they started paying interest on them. And the interest rate had to be a little above the market rate in order to get the banks to hold them. And that worked, so they did. But what's unexplained by that is interest above the market rate was basically 25 basis points, 0.25%. So the fact that the rate was so low had nothing to do with the Fed. Basically, short rates were low around the world. And they were just issuing at the world market rate. Now, they can push that rate up, but if they tried to lower it below market rates, banks would try to get rid of those reserves, and then you'd have a hyperinflation. So basically, the Fed's in a very tight position at this point. They cannot lower the federal funds rate below market without basically causing massive inflation. Now, at least that's what the old monetary theory would say.
What do you think the consequences would be if they have to use a policy like interest rates and they can't do it?
Well, they can control the federal funds rate. That's the one rate they can control.
And what's the difference between the federal funds rate then and the interest rate we talk about?
Well, okay, so the federal funds rate is an overnight interest rate. It's a 1-day, it's a 12-hour rate, basically. It's an overnight rate, and it influences short-term rates. But if you look at the data, the effect peters out very quickly as you extend the maturity. So 3 months, 6 months maturities, basically gone. Or if you plot like the 10-year government bond yield against the federal funds rate, it looks like they're totally unrelated. And what the Fed does with the short-term rate basically has very little effect on longer rates. So my question would be, what company changes its cost of capital based on what happens to the federal funds rate? I don't know of any. So all of what we think happens when what a lot of people think happens when the Fed changes the Fed funds rate, I don't know. I don't see any basis for it in finance anyway. The old macroeconomics might have had a basis for it because they never considered anything but short rates.
Your conclusion from here, or is it inconclusive, whether the Fed controls the interest rates?
They can control the federal funds rate, and that will have some effect on very short rates. Mm-hmm. But in my testing, it looked like most of the movement in federal funds rate was driven by the market, not by the Fed. But they can, if they want to, affect the federal funds rate. But that has very little effect on longer-term rates. It's longer-term stuff that's more important than what businesses do. And that's what they're trying to affect. So I think it's very limited. The scope of monetary policy is very limited.
We could almost imply that market forces have more power or even limit the power of central banks.
Severely, right. They severely limit the power of central banks. The financial markets are basically international. So what one central bank does can be offset by market participants all over the world. So if the Fed buys, for example, long-term bonds, which it did for a long period of time, that's the so-called quantitative easing, well, the market just issues more of them and supplies more. And the effect becomes very muted. That happens all over the place. The Fed is not, banks, for example, are a small fraction of total lending that takes place in the U.S. So even if the Fed could limit the amount of lending done by banks, that would not necessarily be a big deal for the whole financial system. Let's just go elsewhere.
You mentioned in the paper that you actually state on one of your headlines that there's a new game in town.
Yeah.
What do you mean by that? Is that
that was when they started paying interest on reserves.
That is good for the banks then to hold on to those reserves and not to lend them out to others.
Well, that's the only way they could get them to hold on to those reserves, because previously, when there was no interest paid on the reserves, banks didn't want them. So they only held them because of reserve requirements, the requirement to hold a certain fraction of reserves against deposits. But otherwise, they would try to get rid of them. But the Fed wanted to massively expand the amount of reserves way beyond what was required. And the only way to be able to do that would be to pay interest on it.
Can I just ask you, Eugene? Sorry, are you further away from the microphone, or are you close?
Oh, I'm sorry.
There's sometimes
I'm moving around, so I must have put my arm over my microphone.
Oh, that's a lot better, actually. Yeah.
Fantastic.
Okay. So, what's next, do you think, for the Federal Reserve based on your current research?
Oh, they're not paying attention to me, I'm sure. Well, we'll see. But did you see the movie The Invasion of the Body Snatchers?
I didn't, no, but I can imagine.
It's an old movie where there's something's going on in a town, and when people go into that town, their minds get taken over by these, it should be mind snatchers, I guess, but it's called The Invasion of the Body Snatchers. And they become like totally predictable in what they're going to say. And so I say that what goes on when you go to work for the Fed or you get onto the board or whatever, it's the invasion of the body snatchers. Whatever you thought before becomes irrelevant, and you buy the party line. Or you buy the line that says they have a lot of power.
And I'm sure that's like that in a lot of institutions as well.
Right.
That's why they're probably called institutions.
Right.
Yeah, one other movie that comes to mind, actually, I think it's called Equilibrium, and it does the same type of thing. There's microchips in humans, and they try to create a balance, and everything looks quite predictable and under control, and creates, as the title called, an equilibrium. You know, I'm sure at a basic principles level, it's like what some of the economics principles are trying to depict as well, that we can come about an equilibrium if certain variables change. And I'm sure the body snatchers is somewhat a good analogy to describe what might go on in the Federal Reserve. That's not coming from me now.
Right.
Yeah, there's another paper, Was There Ever a Lending Channel?
Right.
You don't mind outlining what the goal of this paper is that you wrote in 2013?
Well, yeah. So what the lending channel says that by changing the quantity of reserves, the Fed changes the ability of banks to make loans, because the reserves would, in principle, not in the current system, but in the old system, the quantity of reserves would affect the amount of deposits banks could issue, and that would affect the amount of lending they could do. But when you actually look at banks' balance sheets, even in the old days when they were important in the lending market, they had a large fraction of marketable securities on their balance sheet. And that would allow them to offset any of the actions of the Fed. So if the Fed curtailed deposits and they weren't allowed to, and they couldn't expand the supply of deposits as a consequence, all they have to do would be to sell off some of these marketable securities that they were holding, and they could expand their loans that way. So it was never really possible for the Fed to have much control over the amount of bank lending. And then slowly through time, you have non-bank institutions that become more and more important in the lending market. And now it's totally out of the question, I think, for the Fed to affect the amount of lending that goes on. So I don't think there ever was a lending channel, but there certainly isn't one now.
And do we need a Federal Reserve?
Yeah, the original, I think the main job of the Fed is to control inflation. Unfortunately, in the current regime, they can't do that.
Because based on your two papers, it seems that they're losing the power that they have in terms of the market forces determining the impact that interest rates might have on economic activity, or the causation might go the other way. And now the lending channel may disappear.
I don't think it was ever there. I don't think it was ever ever important at all. But it certainly isn't important now. But what's happened in the new regime, where they pay interest on reserves a little above market rates, is that basically they lost control of inflation when they do that. That doesn't mean you're going to have high inflation. It just means inflation is what it is. It's not under the control of the Fed anymore. My view is that's the main job of the Fed, is to control inflation. And they've given it up with this new QE regime that they've gone into. And we'll see how that works out in the end.
And do you have any thoughts on quantitative easing?
Yeah, I don't think it's had any effect.
And we should let the market operate as efficiently?
Well, no, I think the fact that it has no effect, or very weak effects, shows you that the market is what dominates everything.
Yeah. And that's going back to classical concepts of economics, if you want to put it like laissez-faire.
Well, it's really, finance is, financing different kinds of security, supply and demand. It's very fungible. It can move to different places. It can take different forms. It's all very changeable. It's not like you build something and you have something in place and you can't do anything about it. With finance, well, you just buy the securities and you issue the other kinds of securities. There's a lot of flexibility in the system, and that's what kind of limits the power of anybody to control the prices and interest rates, including the Federal Reserve Bank.
I'd love to talk about you personally, if you don't mind, Eugene.
Okay.
You mentioned in your bio that you have interests in numerous activities. I don't know if you still do it, whether you windsurf or golf.
Well, I was one of the original windsurfers.
Yeah.
I windsurfed diligently for 30 years, and it's an addiction.
Wow.
You're always looking for the wind. But I had a hip replaced and the addiction went away. So
oh no.
I gave away all my windsurfing equipment, and I played tennis every day for 35 years maybe. And I played with my legs, and now that I'm old, my legs kind of don't do it that well anymore. So I went from tennis to golf. Now I play golf, and I'm fanatical about that. So I'm basically a fanatic, whatever I'm doing.
So that must have been difficult. If you're very fanatical about new things you pick up. I'm just wondering what the 1960s were like, with the LSD and that type of thing. Was there any type of escapism there? Or was it more windsurfing you would have done?
Well, in the 60s, I was married very young, and we had children right away. So I was never into that stuff. It was too important to make a living. So we missed that generation.
And where did you surf? Was it California or?
Oh, we did it a lot in California, right in Chicago. We have a big lake in Chicago.
Okay. Did you find that important to have that type of, if you want to call it, an escapism?
Well, that's why I went into academics. I went into academics because I didn't want to go into anything that would affect my sports life. So academics was a good choice. Basically, in academics, you have to work a lot of hours, but you work the hours of your choice. You don't work the hours that somebody else tells you to work.
Sorry, if you could repeat that again. Sorry, you work the hours of?
You work the hours you choose to work. Somebody doesn't tell you what hours to work except for teaching classes, but that's only like 3 or 6 hours a week. So the rest of the time, you work a lot. But for example, I always worked like 5 a.m. till whenever. But I could take time off in the middle of the day and play tennis or now play golf and still get a full day of work in. So it's having control over your hours that's important.
I was just going to ask you about that. How do you manage that time, that free time? And when I say free time, it's time you choose to do your research in. How do you manage that? Because some people may wait till maybe the evening time or night time and they're constantly working and never look up and give themselves that breathing space for, say, mindfulness.
Yeah. Well, I found out very early on that basically I had a good 4 or 5 hours a day that I could do research in an effective way, in an efficient way. And that after that, I could put in all the time I wanted on research and nothing would happen. So I read other people's papers, but basically you have 4 or 5 hours a day. You can use them in the morning, you can use them in the afternoon, you can use them in the evening, but unless you're a lot different than I am, you don't get more than 4 or 5 hours of productive research time, no matter how much time you spend on it.
Do you have any particular time in a day where you are more productive? Would it be the morning time or is it any time really?
Well, I used to think it was the morning, but now I've pretty come to the conclusion it doesn't matter. I have 4 hours. I can use them in the morning. I can use them in the afternoon.
I'd like to ask you, Eugene, about earlier influences on your work, or even, who would you consider to be an economist or even a school of economic thinking that you had gravitated toward?
Well, I don't know. Chicago's always been a market-oriented institution. And so that was very important. And then the people there, my mentors were Merton Miller and Harry Roberts and Benoit Mandelbrot. So individuals were very important early on to me, especially Merton Miller and Harry Roberts. And Benoit too. Benoit
is an amazing economist. At the same time, when you wrote the efficient market hypothesis, he was writing about fractal markets and relating that to stock markets.
Right.
He got pretty much neglected or hard done by the economics discipline, or am I kind of misleading that thought?
No, economics was not his primary interest. He was really a physicist. Fractals that was kind of the culmination of his ideas, that Fractals book. It was just an application to finance, his work in markets. He didn't have a long-term interest in that.
If you were to step into the DeLorean and time travel, what era would you go back to and who would you like to meet? And if you'd have a conversation, what do you think it would be about?
Oh, I don't know. I don't think in those terms. Today is always the best day.
And why is that? Because it's the present?
Yeah, right. What can you do about it anyway?
Exactly, yeah. Just move on. Yeah, that's it. Do you have any book or books that you tend to gift more often than not or recommend to colleagues?
No. Well, basically I'm a free writer. People recommend books to me that I read, but unfortunately in academics, most of your reading is professional reading. When you have time to read, there's so much stuff that you have to read that's what you read. So I don't really get a chance to do a lot of other reading, but I'm kind of a nut for history.
Are you talking about general history as in American history?
Yeah, just general history. Yeah,
I love my history myself, actually. Yeah.
The problem is those books are always 850 pages long. Exactly 850 all the time.
Yeah. I asked Professor Cochrane, the same question. And he just said, I don't recommend books at all. No one reads them. He's your son-in-law.
Right.
He was telling me at the time. Based on your writing styles or when you're doing your research, do you have any writing tips that you could share with any prospective writer or anybody who might find it difficult to go about starting a piece of research or writing a book?
Yeah. There is no easy way to do it. I do a lot of writing with Kenneth French. We always rewrite these papers that we put out at least 20 or 30 times, front to back. And you struggle over every word and you try to say stuff as simply as possible. Because by saying it simply, you reach more people than by saying it in a more complex way. So simplicity is the first rule, or as simple as possible. And then you have to really work on it, really read it, really get other people to read it and get their reactions. And, organizing how you present stuff. So you want a brief introduction. Most papers tend to have long introductions. A brief introductions, get right into the guts, and keep it as simple as possible for as long as possible, so that you lose the fewest number of people.
I just writing these down. I like to take a collection of tips like this, and that's why there's a slight pause in here, because I think it's useful to come up with tips like this, because usually people do have that difficulty, and when they hear from somebody like yourself who puts out a lot of papers, at least they know that you've gone through the same type of difficulties and you've discovered that yourself. And I've came across these type of tips also from other academics, and it's all about simplicity and time management as well. And some say, do your best work first.
Right.
What's next for you, Eugene?
I don't know.
You live in the present moment, don't you?
Right.
You don't like predicting things or going back to the past.
No, right. That's what makes this business fun, is that you don't know what you're going to do next.
Is there anything you'd like to add, or is there any advice you'd like to give to people who might be listening to this podcast?
No, I don't give advice. Well, I learned early on that my children didn't listen to my advice, so why should anybody else?
Well, maybe we've all matured.
Yeah, right.
Although your children are still your children.
Right.
Do you like any particular music?
Oh, I'm a classical music nut.
And do you sing yourself?
No.
So you like classical music. Vernon Smith likes jazz.
Oh, some jazz I like, but basically classical music.
Okay. Professor Fama, thank you so much for joining me on
Sure, my pleasure. My pleasure.
What I'll do is I'll put all the links for people who want to look at the show notes page on economicrockstar.com/Eugene Fama.
Okay.
Eugene, I don't know if you've ever been told this, but you are an economic rock star.
Yeah, thank you.
Thank you very much for joining me. And
sure, my pleasure.
All the best.
Okay.
Today.
You too. Bye.
Hello again.
Hey.
I really appreciate this.
Okay.
A student of mine, Connor Murray, doing a Bachelor of Business Studies degree, he wanted to ask you a question regarding your opinion on the volatility of Bitcoin and its true value.
Well, I don't know what its true value is, but I'm suspicious about it as a unit of account because it has such an uncertain value. So monetary theory basically says that you want a unit of account that has a stable value so that when you state prices, you don't have to keep changing them all the time. So that if you transact in Bitcoins to buy coffee, that price is going to be different, highly variable when measured in Bitcoins. And monetary theory basically says something like that, namely like Bitcoin with its highly volatile value, can't survive as a unit of account. So we'll see if monetary theory works. So what another way of saying is people that transact in Bitcoin for ordinary purchases probably don't want to keep the Bitcoin once they receive it from a customer. They probably try to get rid of it right away because its value is so uncertain. But what that means, it's an awkward thing to use as a medium of exchange. So who wants to use it? Well, it's very attractive for illegal transactions where the alternative might be to carry around lots of cash. Otherwise, it's difficult to say why anybody wants it at this point.
It might be some people may want to hold on to it. They believe it may have, in terms of their speculation, it would increase.
Well, there has to be some basis for its value as a speculative asset. And its basis has to come from its use as a medium of exchange. If it has no usefulness as a medium of exchange, eventually it will have no value.
And that was the nature of Bitcoin when it was established, in order to act as a medium of exchange and have a currency that's independent of any centralized government. And if no one's spending it, then it fails in its underlying reason for why it was created in the first place.
It's gone.
And then regarding its true value, nobody knows.
Nobody knows, right.
I don't think nobody knows, especially when the futures market was established. It's still uncertain.
The value has to come from its use as a medium of exchange. It has no other use. It's just like having paper currency. If nobody's willing to use it, it becomes valueless.
And do you think it has a place in the future of finance?
Oh, we'll see about that.
Yeah, because we don't have a crystal ball, but
no, right.
Unless we might not have Bitcoin in the future, but we certainly will have some form of cryptocurrency. Whether Bitcoin will be the cryptocurrency that people will fall back on. Well,
we'll have to see if somebody can come up with one that has a stable value, because otherwise it's not going to survive as a unit of account.
And especially when you have so many other cryptos out there, they're all quite volatile in their nature.
Right.
And one that seems to be prominent and one central banks are using or considering adopting, or even retail banks, are the likes of Ripple.
Well, no, there's a difference between the blockchain technology and the unit of account. So you could use the blockchain technology that underlies Bitcoin, but have the unit of account be dollars or pounds or euros. The blockchain technology is totally independent of the unit of account. So if blockchain is a more efficient way to conduct transactions, that's fine. So U.S. banks, for example, will just adopt blockchains, but still state prices, still do all transactions in terms of dollars. So the two blockchain and Bitcoin are not inextricably connected.
It'll be interesting. So I suppose we have to watch the space regarding the finance, and perhaps it all goes back to the theories and the invention of money. And, it'll probably fall back into place if it meets those criteria for currency, store of value. And
currency is only a store of value if it's used for some purpose.
So we should encourage people to spend.
If people eventually say Bitcoin's useless as a medium of exchange, its value's gone.
Especially if you spend it now and the high transaction costs involved, even to buy a copy. I think there was a conference there recently, a Bitcoin conference in America, and you had to pay up to this year. You had to pay Bitcoin in order to enter the conference, but this year they decided to use dollars because the transaction fees are too expensive. So they removed the Bitcoin payment. So and that's quite worrying,
Yeah, if you were holding Bitcoin, it would be.
Yeah, but I suppose the costs may have to come down, and there's a crackdown on by the Chinese and that for mining.
Well, cost is one dimension of an efficient medium of exchange, but variability in value is another. So they're both important.
Yeah, and that variability is important, as you mentioned. So if there's large swings or deviations in prices, I think it brings a lot of uncertainty.
Right.
Depending on whether it has that, as we mentioned earlier on with Jagadish and Titman's paper or Aziz's paper, if it has a momentum. But that tends to reflect a financial asset that's speculative in nature rather than a currency, perhaps.
Well, we'll see.
We'll see. Thanks again, Eugene.
Sure.
I really appreciate it, and have a nice evening.
Okay, you too. Thanks.
All the best. Good night.
Okay,
bye.
Good night. Bye.
If you enjoyed this podcast, why not leave some feedback or comments on the show notes page on economicrockstar.com, where you can also sign up and be a member of the Economic Rockstar community. If you're listening to this episode on iTunes or Stitcher Radio, I would love to have some feedback and for you to leave an honest rating and review, as this will help with the rankings of the show so that more people can find it. If you're listening on the website economicrockstar.com, make sure you check out the back catalogue of all previous episodes and interviews with some amazing professors and authors at economicrockstar.com/podcasts. Thanks for listening, and I really appreciate your loyal support. I know how much you love audio, so why not get a free audiobook with Economic Rockstar today? I've teamed up with audiobooks.com to bring you this amazing offer. Visit audiobooks.com/rockstar to download your free audiobook now.